Good morning, dear students. Welcome you all to the next lecture of JCE Connect series of online lectures. So we are studying the subject construction economics and finance. And in today's discussion, we will be taking the concept of time value of money and discounted cash flow. So actually, the essence of economics starts from these concepts. The previous concepts which we have studied were the theoretical background, and actually from here the interesting and important concept wherein you will have to think as a finance manager or a person who is into the finance will start. So any one of you please give me the confirmation for visibility of the screen and voice. Both are clear?
Yes, sir, both are clear.
Fine, thank you. So let's come on to the concept of time value of money. So it is the value of money at a specific instant of time. It was never the same in the past, nor it will be the same in the future. The value of money changes with time. Every single rupee has its own value and it changes with time. So now, today we'll be discussing the concept of time value of money. The concept is simple. The concept says that the money what you have now will physically remain the same tomorrow or it might be the same yesterday. But as per the value with time, it changes. That is what is time value of money. So money at this moment, what you have will not have the same value in the next moment, or money which you had in the previous moment will not have the same value at this moment. So this concept is purely based on the flow of money, investments, retentions of money, and how you manage your finances. Now, when we go into our engineering studies, we hardly have something related to finance management and something. We don't value our own money. Say a single rupee spent, we feel 1 rupee is like, it's very low, okay, or it doesn't have much value. So, on similar basis, our spendings happen. So, for example, you join a college, you pay the fees, which is a lump sum amount and all. But side by side, you have your expenses, which are say 5 rupees, 10 rupees, 15 rupees, 20 rupees, for which we never keep an account. For example, say your traveling expenses are there, the food expenses are there, which you have in the college, you have some other stationery expenses, you have Xerox expenses. So those all expenses we don't count. Secondly, we don't bother also to count because it's like 5-10 rupees and we feel like we should not think much before spending that amount. But if you make a small exercise, say once the college starts, you keep a small diary and you maintain the records of these small amounts, what we call as chiller money amounts we spend. At the end of the day, you'll realize that is a considerable amount. So that is what is time value of money. So whatever you spend, each and every rupee accounts for something, and it should be spent wisely or it should be invested wisely. So time value of money is the basic concept of economics which we compulsorily need to absorb as a civil engineer or say any profession. Now many times we see that our moms or say someone, they save money, they collect the money and keep inside somewhere. Okay, they keep it because they feel it is safe. So say after 1 year or 2 year, they remove that money. So before 1 year, they might have saved say 5,000 rupees. So after 1 year, if they remove that money from there, how much it will be? It will be 5,000 only physically, but the value of that money is not 5,000, because as time goes ahead, the value of money changes, and that is what is a concept of time value of money. After studying this concept, what I want my students to do is keep account for each and every rupee you spent, Keep account for each and every rupee you invest. Keep account for each and every rupee which you don't do anything, which lies in your pocket. Okay, because the concept says that if the money is in flow, money will grow. If the money is stagnant, money will not grow, and it is a form of loss. So let's see the principle of time value of money. The value of money at any point of time is different, or the value of money changes with time. The time value of money emphasizes on the concept that money you have at present is worth more than the identical sum in future due to its potential earning capacity. So this last three words are very, very important. So due to its potential earning capacity. Say now you have some amount, say 10,000 rupees you have, and you keep it in your safe. Okay. After 5 years, you remove that 10,000. Physically, how much you have? Neha, physically, how much money you'll have? Hello, Shabaz, are you there?
Yes, sir. Yes.
Yeah. So you have 10,000 rupees. You have kept that 10,000 rupees with you for 5 years.
Yes, sir.
After 5 years, you remove that from your
Yes.
cupboard. How much money will you have?
Yes, sir. So
कितना पैसा रहेगा रे?
that
Same.
much
How much
only,
you had
sir.
kept? Yeah, that much
Sir,
only. So it will
हाँ sir,
not
उसमें.
grow. It will उतना ही रहेगा वो कुछ नहीं होगा उसको.
Sir,
But if
हाँ
that's
sir.
yeah,
If you put
it-
if you put in the bank, sir, they will
yeah,
give interest, sir.
it
That's
will
only.
give interest, right? So if you put in bank, you'll get interest. That means money grows. Okay, and same after 5 years,
Yes, yes,
you might have it doubled also if you have invested it properly. So that is what is the principle of time
yes,
value of
sir.
money. It says that at any point of time, the value of money will change. So this will help you in potential investment or say potential growth of money. Now, how the money grows? Okay, the value of money changes. The value of money changes with a factor termed as discounting. Okay, the value of money changes with a factor termed as discounting, which is expressed in percentage. So generally in our terms, it is rate of returns or rate of interest. So now for us, discounting is a term, or a discount is a term means where we are getting something off. So in actual economics, discounting means it's like rate of interest or rate of returns, which is denoted by a symbol small I, and it is in percentage. So discounting factor, when you say discounting factor means how much interest are you getting or how much you have to pay. So always remember that as per the principle of time value of money, money always grows. If you keep the money stagnant, okay, you are in a loss. So as we said, as Sabas you said rightly, if you are keeping 10,000 with you for 5 years, after that it will be 10,000 only. But if you go with financial terms, you are in a loss, because if that 10,000 instead of keeping in your home, if you would have kept in a bank, now the rate of interest have come down, fine, but still money would have grown. That 10,000 would have upgraded itself, 10,000 plus something. 10,000 plus something, how much? That depends on discounting factor. So what is discounting? It is the percentage by which the money will grow. So in our general terms, we term it as rate of returns or rate of interest. So these two terms are the ones which will be dealing much more than discounting. Okay, discounting is a general term which we use in economics, but rate of returns of rate of interest is that term which we will use in our regular day-to-day course of life. So to highlight this, I have kept a small example. If the money is invested, it will increase as per the rate of returns. For example, if a person invests a sum of say 1000 for a period of 1 year at rate of returns of 10%, then he'll get a sum of 1100 at the end of the year. 1000 is his own investment, and 100 rupees what he gets with a discounting factor of 10% is the growth. So what does the time value of money concept tell you? Money will be growing. Okay, money will be growing. The value of money what you have today will not be the same tomorrow. One more thing it says is what you have today in hand is important than what you are expecting tomorrow. Because if you have something in hand today, you can invest it, you can grow it, and you can make profit out of it. But if you don't have anything today but expecting things tomorrow, then that doesn't fit in the principles of economics. So now when you go into contracting or when you become a project manager, again I'm looking at all of you all as a project manager. Okay, you'll be dealing with lots of money. Funds will be coming, cash will be going, cash will be coming. So the previous terms which we have studied, that is the credits, how to manage the credits, how to take the loans. So these all things will be dependent on time value of money. So each and every rupee you invest has to give you returns. And on the other hand, the next point, if the money is borrowed, it has to be returned, accounting for the rate of interest. Okay, accounting for the rate of interest. So generally, when we invest, we get back something. That time we use a term rate of returns. And when we are paying, we pay depending on the rate of interest. But in general terms, rate of interest is only used both the ways. Even if we are investing also, we say what are the rate of interest I am getting. Even if I'm taking a loan also, I'll say that the interest rate is whatever percent. So that overall is termed as a discounting factor. So discounting factor is that term by which your money value changes with time. If you have invested, your money will grow. If you have borrowed, you have to pay more money. For example, here, if a person has borrowed a sum of 1,000 rupees for a period of 1 year at a rate of interest of 12%, then he'll have to pay a sum of 1,000 he has to pay, which is the principal amount. But upon that, he has to pay 120 rupees extra because he has borrowed. So this is the basic principle. So from now here on, you all also, I request you all, okay, value a single rupee. When you are spending, ask yourself, are those spending worth? Okay, it's not that don't live your life lavishingly. Okay, you can live your life lavishingly, but there are many things in which we make unnecessary investments. Okay, now here we will get attracted by some schemes. For example, if you go to that Lenskart website, what they say is buy two get two free or something of that sort. At one point of time, you can wear how many specs? You can wear only a single specs, and that is the basic requirement. But what happens is because of this discounting factor, what they give, okay, or they say if you purchase to this much percentage, cost will be reduced, we get attracted and we over invest. So once we over invest, we are losing the time value of money, whereas the company in which we are investing or purchasing things, they get the advantage of time value of money because they are getting more funds. Okay, they are getting more funds, and maximum time it happens in our shopping. Okay, we go with the aim of purchasing say one, two, or three goods, but while coming we have four, five, six goods. Okay, so that is what is the concept of time value of money. So always remember, each and every rupee, value it, invest it, let it grow, so that you'll earn the profit. If you have borrowed, repay it, and while you repay, you will have to always pay more than what you have borrowed. That is the basic principle of time value of money. So time value of money is a concept which tells you that money doesn't remain stagnant. It always grows. If you keep the money stagnant, you are at a loss. That is what is the basic thing of time value of money. So now I've taken a lively example here, wherein I have taken the exchange rate of US dollar and Indian rupees. Now, if you all know, this dollars and all commodity market, this changes day to day or minute by minute also it changes. So I have taken that period where activities will be the most, that is the financial year ending. So now anyone can help me to read this table on your own, like what you get from this table which is displayed. Can anyone put an attempt and try to explain this? I'll explain you, not an issue. From your side, anyone can tell me what it is?
Sir, $1 equals to 75.45 rupees in Indian
Yes.
currency
On what date?
on the 20th April.
April. Okay. So
But
I've taken a period from 20th April to March to April. Okay. So yes, next, go ahead. Anyone else?
Sir, on an average, the
Yeah,
Indian currency value will be around 73.403,
403
where
over
one
this period.
dollar equals to 73.403.
13.403. Okay. And on
And
March 17th, we had the lowest, that was
yes,
72.29. Okay, fine. Okay, now on this, I'll put up a easy question. If you are taking, say, admission for some course in US, okay, and you had to pay money as fees, at what point you will pay? Will you pay that fees on 20th April or will you pay the fees on 17th March?
17th March.
17th March.
March. Yes, you'll pay the fees on 17th March. Why it is? Because your rate is that time the lowest. Okay. And this is what has to be seen. But say if someone wants to send money to you from US,
20th April.
20th April, right? Because one, if he sends you $1 that day, okay, it is like you're getting how much? 75.45. Means if he sends you $1,000, 1,000 will be multiplied by 75.45. Whereas if you would have sent on 17th March, that 1,000 would have only multiplied by 72.290. Or say in between average was 73. So this is what is one example wherein you can get the time value of money. If anyone follows the share markets also, okay, you get that exact concept of time value of money. Within no time the prices of the shares will vary. Okay, so you have that stop loss, you have that upper limit, those all things you keep. Why you have to do that? Because value of the shares changes with time, and that is also one part of time value of money. So when you're investing, you can invest when the rates are low, but when you're getting something, try to get that when the rates are high. So if you want to book a ticket also, and if you have to pay in dollars, in that case you have to keep a watch, or you have to track wherein the amount is least, and that makes good difference. Because when we compare ourselves with dollars and all, even say here and there $100 also will make an considerable difference. $100 becomes like 3-4 thousand rupees ka difference ho jayega if you check the highest price and lowest price. So that is what is the concept of time value of money. I felt that this example can make the things clear in a better way, how the value of money changes with time. And always remember, as you will be in the field where you'll be dealing with money, these all currency rates and all, you should have a track, because sometimes some purchases are done in dollars. Okay, so dollar is an worldwide accepted currency. So this basic things, you make it an habit. Just once in a while, at least go through the websites which will tell you what things are happening in the economics world. So anyone wants to put up any points or any of your suggestions or anything regarding this time value of money?
Gold, sir.
Yes, gold. Yeah, gold is also there. All this commodity market, what we say now nowadays, petrol also. Daily the prices of petrol are varying. Okay, so if you are a big contractor and you require lots of diesel for your equipments, say for a two-wheeler, it's okay, because at the max, how much we fill in a two-wheeler, say petrol of 300 ungeared vehicles, or say if you are using a bike, we can fill a petrol of 500. Means a maximum 5-6 liters or 7 liters, 8 liters will go. So if the cost varies by one rupee also, we might have to pay 10 rupees extra. But it is not the case with those machineries or equipments which are huge and which require a lot of fuel. Okay, which require a lot of fuel. Anyone is here who is working in the contracting field? Anyone is there who is working in the contracting field?
Yes, sir.
Yeah, Vivek. So can you tell me, like, generally your trucks and all, how much diesel they require?
So for the truck mileage is around 3 kilometer per liter.
Okay, and the tank capacities are
Tank capacity is around 100, 150. It varies, sir,
150.
different.
Okay, yeah, nearly say on an average, even if we take 100. Okay, so for you, this value will matter a lot, right?
Yes, sir. Yes, sir.
Yeah, yeah. So again, as Naveen, you said gold. I'm telling an example of your fuels, that is petrol or diesel. So this is what is the concepts of time value of money. You have to keep a track when the things are happening, what are the things happening, and that will give you extra knowledge also. And when you get an opportunity to present something or this thing, these all added facts will add up to your knowledge, or your presentations will be more healthy than just to sticking up to the points what are there. Okay, now I've added up this point, it is not like directly concerned with your syllabus, but now this opens one more ideas, like you start thinking, yes, dollars is there, Indian rupees is there, we have so many currencies. If we have the currency of Bahrain, okay, those all currencies are too rich. Okay, they are like 160 and all हो जाता है अभी. इधर डॉलर में 70-80 में खेल रहे हैं, वहां गए तो 160-180. Okay, Riyadh and all those currencies are too high. Okay, so that is what is termed as exchange rate. So this is what is one thing which is concerned with your time value of money. So now
So share
let's go.
market also.
Yeah, share market. I told it. Yeah, share market is directly related to it, and that is at least minute by minute related. Within 2 minutes, your share values will come down. Within 2 minutes, your share values will go up. Okay, so at least with these, like hourly variations might happen. Okay, but share market, as Neha you rightly said, it is minute by minute variation. If you're doing something called as intraday and all, you have to be very active, because time value of money matters a lot in these things. So next is we'll come to a cash flow diagram. So this is a very nice diagram, which is a basic thing which will show how your cash is flowing. So the graphical representation of the cash flows, that is both cash flowing outwards, cash coming inwards with respect to a time scale, is referred as cash flow diagram. Okay, is referred to cash flow diagram. Okay. The cash outflows, that is the cost or expenses, are generally represented by a vertical downward arrow, and the cash inflows are generally represented by a vertical upward arrow. The horizontal axis is the timeline for which the cash flow is analyzed. So now cash flow diagram is a basic necessity. In the problems which we will be solving further, we will have to put an cash flow diagram. And in the exam also, when you solve the problems, these cash flow diagrams, if the example is for 10 marks, this cash flow diagram carries 2 marks. I think in your CPM you have put those network diagrams. Okay, similarly here we have cash flow diagrams which are quite easy as compared to those network diagrams. So now this is a typical cash flow diagram. Now when we see here, okay, when we see here, we will see that this is your cash inflow and this is your cash outflow. Now cash outflow means your investments, cash inflow means your gains, and this horizontal line will represent the time axis. So here is a general example. Now we'll discuss this first example which is there. I have referred NPTEL notes for this. When you go to NPTEL website, there is a complete module of this subject, and those notes are also very good. I have the downloaded things, I'll share with you all, but if you wanted to do it on your own, NPTEL website, you can go and there nice things are given. So now here I have put up a typical cash flow diagram where I have my time axis starting from 0, that is the point of investment, up to say 10 years. Okay, 0 up to say 10 years. So what is happening at the initial stage? I am putting in 1 lakh of rupees. Okay, at initial stage, I am putting in 1 lakh of rupees. So from 0 to 1 means here it is end of year 1. Okay, 0 to 1 means at the end of year 1. So what is happening? Nothing is happening. End of year 1, 2, 3, nothing is happening. But at the end of year 3, here I'm getting some returns. Okay, here I am getting some cash inflow. Inflow means the returns. So I'm getting an inflow of 35,000. Then again, at the end of 4th year, I am again investing back 15,000. Okay, I'm again investing back 15,000. And then again, I go to 4 to 5, nothing is happening. 5 to 6, 6th year, I'm getting again a returns of 80,000 at the end of 6th year. Again, at the end of 7th year, I'm putting 25,000. And 8th year, I'm not getting anything, not investing also. 9th, I'm not getting anything, investing also. And at the end of 10th year, again, I'm getting 45,000. So upward arrows are the cash inflow, which are the gains or the profit. And downward arrows are nothing but your cash outflows, which are the investments or any other thing for which you are putting the money. So now here, if we go with the total cash outflow, the total cash outflow is 1 lakh plus 15,000 plus 25,000, which is around 1 lakh 40,000. Whereas the total cash inflow which we are getting is 35,000 plus 80,000 plus 45,000, which is 1 lakh 60,000. Means when we complete this cycle of 10 years, I'm getting some 20,000 extra. So this is what is a cash flow diagram. So cash flow diagram is very, very important, and this cash flow diagram can be put for each and every financial activity. Okay, each and every financial activity we can put a cash flow diagram. So for example, now we have to put such diagrams for our basic civil engineering works. Say I'm constructing a building, I'm a contractor. So cash outflow will be there for materials, labors, execution, everything, and cash inflow will be the advances taken from the owner. Or say if you have outright contract that you have to finish the works, then you'll get the money. Only cash outflow will be there up to the end of the project or up to the handover. And at the end itself, at the last handover stage, you'll have one cash inflow. Now, here we can take some silly examples also. Say a student's life who is staying in the hostel. So cash inflow is the amount sent to him by his parents or his own savings. And then cash outflows are many. His daily food expenses are there. Okay, mess bills will be there. Then his mobile recharges will be there. Then some other entertainment activities will come in. So all those things will be cash outflow. So what happens is at the end of the month, that cash outflow, if it doesn't match with the cash inflow, he will go in debt. That is udari. Again, for next month, cash inflow starts, and again outflow is also maintained. So you'll have to maintain this cash flow diagram. Then you'll understand how are your expenses going and how is your money coming. So if you are a business person, this will be very, very important. This is a typical cash flow diagram. Now, based on this only, further applying your CPM PERT concepts, we get the software such as MS Project Primavera, by which once you update the activities and the related costs, automatically you will get this cash flow diagrams. So if you are into contractor, now building example, if we take, okay, if we take the example of a building, I'm constructing say G+1 simple residential building. So can anyone tell me where will be the highest cash outflow? Where will I require to spend highest money at what stage? I'm taking a general example of a simple G+1. Yes, Shaban.
At slab time and structural elements.
Okay, yes, correct.
At
Prasad,
ground
anything
level.
you want?
At
Ground level. Okay, fine. Okay, good. So now what happens here is if you have deep foundations, okay, if you have deep foundations, then at ground level itself, when you go for foundation work, you have a quite heavy cash outflow than your simple footings or regular footings. Then once you come up to the plinth work, as a plinth doesn't have any slab, you start with your RCC work, your cash outflow starts. And when we come at the slab level, as Shabazz said, you'll require the highest cash outflow level. So for example, if the owner has given you an advance, so you'll have to manage the advance on your cash flow. You'll have to prepare an cash flow diagram. Okay, you'll have to prepare an cash flow diagram. On that basis, you can plan and further match with the actual cash flow diagram. Because many times what happens is, as we civil engineers are very good in technical things, but we lack financial knowledge. And here is where we have difficulties in managing the cash. So use the credits which we studied in the previous topic or previous concept. Use the credits wherever you have. So if you use credit, what happens? If you use credit, okay, credit, last class we have studied what is credit, how credit can be used. So if you use credit, what will be restricted? Cash inflow or outflow? Again, I'm repeating, last class we have studied what is a credit, how you can use the credit. Okay, I think Vivek also given the number of days they can keep the credit. If we use the credit, what happens? Cash outflow is restricted or it will become more. Any one of you?
Sir, outflow will be restricted, sir.
Yes, correct. For that particular period of time, we can have and control on the cash outflow. Because as Shabaz rightly said that during the casting of the slab, expenses will be more because more labors will be coming. We want some other things such as water will be required, electricity will be required, and those mixers will come. All those things we have to do. And for some things we have to pay instantly. So at that time, our cash outflow will be more. So if we get cement on credit basis, what happens is at that peak point of cash flow, we need not pay to the cement dealer and we can keep a check of your cash flow outflow, especially cash outflow. Then once the brickwork starts, then once you start making his payment, you can balance the outflow. Otherwise, what happens is your cash outflow at certain period increases. So as a project manager, what you have to see is those activities which will have an heavy cash flow will not occur simultaneously. If they occur simultaneously, your financial needs in that particular period will increase. Now, this goes in concept called as portfolio management, where last year we had work a project. It was project related to AIMS Nagpur, where 18 buildings are coming up, and my student was working a contractor who had a contract of 7 buildings, and they were simultaneously running the works for 7 buildings. So when such things are happening, if you have sufficient funds, it's well and good. But if you are in a condition where you have to manage the funds, then you have to delay some activities or say speed up some activities such that at same point of time when you are handling a portfolio, the activities which will cause an heavy cash flow, okay, heavy cash outflow will not occur at a time. Okay, so that is important. So now generally what happens is when you are taking admissions, the cash outflow will be heavy because you have to pay the fees, you have to see for your room rent, salons, this, that. And then for the next semester, as your main fees is paid, the cash outflow is not that much. That time you can have some savings. But again, when the next year comes, important will be again paying the fees, for which again you'll require some cash outflow. So you got to plan your cash flow diagram. So does anyone of you all have anything to say on this cash flow diagram? Anyone has to comment anything or anyone has their inputs on this cash flow diagram? Is it understood what is a cash flow diagram?
Yes, sir.
Surely. Okay. So what you can do is
Yes,
for simple activities, you can say how is the cash flow diagram. So based on that cash flow diagram, when the owner asks you, like at what time, how much amount I should pay. Many times we know, let's see, sir, we'll see, we'll tell, we say. But if you are a contractor with construction management background, you will have an cash flow ready for your project so that you will be able to tell the owner, yes, sir, after 2 months, I'll be requiring approximately this much amount. After next 1 month, I'll be requiring approximately this much amount. So what happens is, as you take the advance amount from the owners, you will not need not spend from your own pocket. See what happens if you spend from your own pocket, that money goes against the principle of time value of money. Because if your agreement is such that you are taking advances and building, and if you don't take advance and you put money from your pocket, your money is dying, because the money from your pocket you should have invested somewhere else, and again it would have been a source of returns for you. But wherein what you are doing, you are putting money from your own pocket, feeling that yes, owner will give, but owner delays the payment. What happens there? Your money dies because already you have invested it and you don't have direct returns from it. Whereas the owner who had promised to invest, he is delaying, his money is growing there. Okay, so that is where your cash flow diagrams will be very, very, very important. So that is what is a typical cash flow diagram. So then coming to the next concept, that is discounted cash flow. So it is directly mentioned in your syllabus. This concept is there. Discounted cash flow is a valuation method used to estimate the value of an investment based on its expected future cash flow. Discounted cash flow analysis attempts to figure out the value of an investment today based on projections of how much money it will generate in the future. This analysis makes it clear how long it would take to get the expected returns. So this point, third point, will be very, very, very important. To calculate what is a certain amount of money is worth in the future, you have to discount it. And hence this method is called as discounted cash flow method. Okay, so now discounted cash flow method is a very nice method which will be helpful for you all to predict. If you are investing, say, 1 lakh of rupees today in some business, and after 5 years, what will be the expected returns? So it will account for all those expenses and it will tell you at the end of 5th year how much returns you have. So if you want some fixed returns, okay, if you want some fixed returns after 10 years, I'm going to retire. At that time, I need one fund of 1 crore rupees. How much I should save from today? That again, you can be counted by using this discounted cash flow method. So to make these all calculations, you require some factor which we term as a discounted factor, and hence this method is known as discounted cash flow method. Okay, so this analysis is very nice and it will make the things clear to you all how we have to take an investment decision. Now you have taken an investment decision to do some course. Say you are paying, say, 25,000 fees. Okay, so how will that 25,000 come back to you? Knowledge you'll gain, fine, but beyond that, how you can recover that 25,000 which you have invested should be calculated, and how much time you'll require to calculate it, that will be important. So here what happens is, in the discussion part, I like to tell you all one example. Say some person XYZ has rented a house for which he is paying a rent of 15,000 rupees. Okay, for which he is paying a rent of 15,000 rupees. And he has given 1.5 lakh as deposit. Okay, he has given how much as the deposit? 1.5 lakh as deposit. He has given to the owner. And per month he is paying 15,000 as the rent. So actually how much rent he is paying? Can anyone tell me? Once again, I'll tell the example. One person has taken a flat on rent. He is paying 15,000 rupees per month as the rent. And during the agreement, he has paid 1.5 lakh rupees as the deposit. Okay, so he has paid 1.5 lakh rupees as the deposit. And he feels that I'm paying 15,000 rent. Is he actually paying 15,000 rent? Or is he paying more, or is he paying less?
Sir, he's paying more, sir.
So he's paying more.
He's paying more. Okay. So
If the owner has put it in the bank, sir, that money, the
yeah,
bank will give the interest.
yes, right. Correct. So anyone else wants to tell something in this case? Ramakrishna, are you there? Atiya, will you like to add up something? What happens actually? Neha, will you like to add up something?
Yes, sir.
Yeah, please
So
go ahead.
instead of giving it to the owner, if he would have kept it in the bank, he would have got the more interest, sir.
Yeah, you would have got the more interest.
Instead of giving the
Yeah,
owner will
right.
get the benefit.
Benefit. Ravina, what you say? Is the rent 15,000 or 15,000 plus something?
It is 15,000 plus something because the
Plus
rate,
something,
the
right?
interest, what the bank gives the owner for
Yes.
keeping 1.5 lakh deposit,
Yeah.
that will be gained by the owner itself,
Owner
not the person who
means
rent place.
in a correct. Very nice. Thank you. Correct. So say for example, if you're keeping that 1.5 lakh rupees in a bank which is offering you 10%, nowadays banks don't offer you 10%. That's there. If you're keeping in some society with a risk, that's there. So if you're keeping, say, 1.5 lakh rupees at a rate of interest of 10% per annum, you are getting, means over 1 lakh you are getting 10,000 rupees. Okay, so totally for 1.5 lakh you'll get 15,000. That means his rent, actually what he's paying is 15,000 per month plus 15,000 which would have been the interest divided by 12. So always remember, when you are taking something on rent, for example, say you need a go down space on rent. Okay, you need a godown space on rent. They'll say that only 9,000 will be the rent or 10,000 will be the rent, but you have to give 5 lakhs as the deposit. What we feel is we have cash with us. Let us give 5 lakh rupees as the deposit, but our regular cash flow will be only 10,000 as we have to pay 10,000. And after 2 years, we'll get that 5 lakh. But that 5 lakh which you have paid, okay, that multiplies. So you'll have to crack a deal. Okay, you have to work out whether paying a rent of, say, instead of 10,000, paying a rent of 15,000 and reducing the deposit to 3 lakh for a period of 2 years will be beneficial, or say paying a rent of 20,000 and paying a deposit of only 2 lakhs for a period of 2 years will be beneficial, or the offer given by the owner, okay, wherein he is paying 10,000, asking 10,000, and but the deposit is 5 lakh is worth. So this is what is called as asset management. And you as construction managers will have scope in this asset management field also. So what is asset management is, one person will come, he'll say, these are my assets, you handle them, I want to earn this much. So you'll be in charge of those assets. Then you'll have to handle those assets wherein we have big office spaces. A person builds a big building and complete 2 floors he wants to rent out. So he'll not roam in the market searching. He'll come to you and you are his asset manager. So he says that I'm expecting this much of rent. You manage my assets. At the end, I want this much. So you come in this role of asset manager. Okay, so this is where your cash flow diagrams and your time value of money will be very, very important. So at the end of this lecture, I'll be trying to put up some more value additions as you have attended the class.